New York City, September 1929. 3 weeks before the crash that would destroy $40 billion of wealth and plunge the world into its deepest depression, John D. Rockefeller was buying, not panicking, not warning his friends, not writing urgent letters to the Federal Reserve. Buying, quietly, systematically, through intermediaries who left almost no paper trail, converting one form of asset into another. His contemporaries thought he was confused, possibly senile. The market had been rising for years. The newspapers were euphoric. Economists at the most prestigious institutions in America were publicly declaring that the United States had achieved a permanent plateau of prosperity. Rockefeller was buying things that made no sense in a rising market. He wasn't alone. Joseph Kennedy, father of a future president, former bootlegger, current Wall Street operator, had a famous story he told later about a shoeshine boy who gave him stock tips in the summer of 1929. Kennedy's conclusion was not that the shoeshine boy was clever. His conclusion was that when shoeshine boys are giving stock tips, it's time to sell everything. He sold everything. Then he started buying something else entirely. What Kennedy and Rockefeller and a small number of others bought in the months before October 1929 was not what any financial advisor of that era would have recognized as an asset at all. It was not gold. It was not bonds. It was not real estate in any conventional sense. It was position, a specific, structured, legally architected position relative to the crash that was coming, a position that would allow them not simply to survive the destruction of $40 billion of paper wealth, but to capture a portion of that destruction as it happened. The conventional account of what rich people buy before a crash focuses on the obvious: gold, land, cash, foreign currency, commodities. These are real. They are also the answer that was already available to anyone reading a newspaper in 1929, in 2008, in every crisis that has ever been sufficiently predicted to allow preparation. The assets that made Rockefeller richer during the Depression and Kennedy one of the wealthiest men in America were different. They were invisible to most observers because they didn't fit the category of asset that most people were trained to recognize. This video is about those 5 assets, the ones that the richest people in history have consistently acquired before economic crashes, not because they are secret, but because understanding them requires a different framework for thinking about what value actually is. Before we examine what they bought, we need to understand what they understood that almost nobody else did. The crash of 1929 was not a surprise to everyone. It was a surprise to most people. The distinction between those two groups, the majority who were surprised and the small minority who were not, was not access to secret information. It was not intelligence, not education, not even experience. It was a framework for understanding what prices actually represent. Most investors in 1929 believed that a stock price represented the fundamental value of the underlying business. When prices rose, it meant businesses were becoming more valuable. When businesses became more valuable, it was rational to pay more for them. This framework was wrong. And the wrongness was not hidden. It was visible in the data to anyone who looked at it with the right questions. Price-to-earnings ratios in 1929 had reached levels that implied investors expected decades of uninterrupted growth. Margin debt money borrowed to buy stocks had reached levels that meant a small decline in prices would trigger forced selling that would accelerate the decline. The Federal Reserve had been raising rates in ways that historically preceded contractions. None of this was secret. All of it was publicly reported. The framework that most investors used simply filtered it out as noise. The small group that moved correctly before October 1929 shared a different framework. They understood that prices in a speculative market don't represent fundamental value. They represent the current consensus of what other people believe about future prices. And when that consensus becomes sufficiently detached from economic reality, the correction is not a possibility. It is a mathematical inevitability. Understanding this distinction between price as value and price as social consensus was the cognitive prerequisite for buying the 5 assets we are about to examine. Without it, the assets don't make sense. With it, they are the most rational purchases a person can make in the months before a crash. This is not insider trading. This is something older, more legal, and more powerful. In the months before the 1929 crash, a small number of wealthy Americans began systematically acquiring positions that would increase in value if markets fell. Short positions, put options in the terminology of modern markets, instruments that paid out when prices declined. What made these positions valuable was not the instrument itself. It was the information asymmetry embedded in them. The person who holds a short position in a falling market is not simply making money. They are being paid by everyone on the other side of the trade. The people who are still buying, still believing, still holding the consensus view that prices will continue rising. The transfer of wealth that happens during every major market crash is not destruction in any absolute sense. Wealth doesn't disappear, it transfers. From the people who held the consensus view to the people who held the asymmetric view. John Paulson understood this in 2007. While the rest of Wall Street was packaging and selling mortgage-backed securities as AAA-rated assets, Paulson's firm spent 18 months and significant capital-building positions that would pay out when those securities failed. When the housing market collapsed in 2008, Paulson's fund made $20 billion in 12 months. It was the largest single-year gain in the history of investment management at that point. He didn't steal it. He didn't manufacture the crash. He simply held the correct view about what mortgage-backed securities were actually worth when almost everyone else held the incorrect view and structured a position that would be compensated when reality eventually aligned with the evidence. The asymmetric information position is the first asset rich people buy before every crash. Not because they know something illegal, because they are willing to hold a view that the available evidence supports when the consensus holds the opposite view, and to structure their exposure accordingly. The consensus, by definition, cannot hold an asymmetric position. If everyone holds it, it is no longer asymmetric, which means this asset is, by structure, only available to those willing to be wrong in the eyes of the majority until the majority is forced to update. Chicago, 1930, 1 year into the Depression. A real estate developer named Samuel Insull controlled a utility empire worth $3 billion at its peak, one of the largest private fortunes in America. By 1932, he had fled to Greece to avoid prosecution. His empire had collapsed entirely, taking the savings of hundreds of thousands of small investors with it. 40 miles away, in the same city during the same depression, a different kind of wealth was being constructed. A small number of Chicago attorneys and their clients were doing something that looked, from the outside, identical to what Insull had done. They owned properties, they controlled assets. They had structured financial positions of significant complexity. The difference was invisible until the crash tested it. Insull's wealth was structured for a rising market. Every layer of his holding company structure was designed to amplify gains on the way up. When the market turned, those same structures amplified losses with identical ferocity. The legal architecture that had made him appear spectacularly wealthy in 1929 functioned in 1932 as a machine for destroying wealth. At maximum speed, the Chicago attorneys' clients had built something different. Their ownership structures were designed not to maximize gains in prosperity, but to survive and isolate losses in collapse. Trusts that separated personal liability from business failure. Holding structures that allowed one entity to fail without pulling down the others. legal arrangements that positioned certain assets outside the reach of creditors when the businesses attached to those assets became insolvent. This is the second asset that wealthy people acquire before every crash. Not physical assets, not financial instruments, legal architecture, the deliberate restructuring of how ownership is held, so that when the crash arrives and the legal machinery of bankruptcy, creditor claims, and forced liquidation begins to operate, the assets that matter are positioned outside its reach. This is not fraud. It is not evasion. Every element of it is legal, documented, and in many cases encouraged by the tax code. But it requires being built before the crash, not during it. The moment a crash begins, the legal windows that allow this restructuring close. Transactions completed after insolvency is visible are subject to clawback. Transfers made when a creditor's claim already exists can be reversed. The legal architecture has to be in place before the creditors arrive, before the crash makes the need obvious, before the legal machinery is already in motion. J. Paul Getty understood this with particular clarity. During the 1930s, while his competitors were being destroyed by creditor claims on assets they personally guaranteed, Getty operated through a structure of holding companies so carefully designed that his personal exposure to any single failure was legally isolated from his exposure to every other failure. He didn't just survive the Depression. He bought oil fields at Depression prices, distressed assets sold by bankrupted competitors through entities that were legally separated from each other and from his personal balance sheet. Each acquisition was ring-fenced. Each failure was contained. Each success compounded without contaminating the others. The legal architecture was the asset. The oil fields were almost secondary. This pattern repeats in every major crash with remarkable consistency. The wealthy who emerge from economic catastrophes with their positions intact almost invariably had restructured their legal ownership architecture in the years before the crash. The wealthy who are destroyed almost invariably had their personal wealth exposed to the full force of creditor claims when their businesses failed. The difference between the two groups is not intelligence, not foresight, not even luck. It is the presence or absence of legal architecture built in advance. This requires careful definition. Because this is the asset most commonly misunderstood, most frequently simplified, and most consistently undervalued by everyone who isn't already wealthy. It is not skills in the general sense. It is not education. It is not talent. It is a specific person or a small group of specific people whose particular combination of knowledge, relationships, and reputation creates a capability that cannot be replicated elsewhere at any price, and whose services become dramatically more valuable during a crash precisely because everyone needs what they know and almost nobody else can provide it. Before the 2008 financial crisis, the wealthiest investors in the world were not competing for the same assets. They were competing for the same people. A restructuring attorney with 20 years of experience in complex bankruptcy proceedings. A distressed debt specialist who had navigated 3 previous cycles and maintained relationships with every major creditor committee in the country. A forensic accountant whose specific expertise in unwinding complex derivative positions made her the only person in a given room who actually understood what certain securities were worth. These people were worth more in 2009 than they had been in 2007, not because they had acquired new skills, because the crash had made their existing skills suddenly critical to outcomes worth billions of dollars. The wealthy investors who had retained these people before the crash through advisory relationships, through employment, through equity partnerships, had acquired an asset that was unavailable at any price once the crash arrived. When Lehman Brothers collapsed in September 2008 and the financial system began seizing simultaneously across multiple asset classes, the people who could actually navigate the resulting complexity became the scarcest resource in global finance. Their phone lines were unavailable. Their calendars were full for months. The investors who had established relationships with them years earlier had access that no amount of money could buy in the crisis itself. This is the human capital monopoly, not the skill. The relationship with the specific person who has the skill when that skill is most scarce. Warren Buffett has articulated this principle more directly than almost any other investor. His practice of investing in businesses run by exceptional managers and then retaining those managers regardless of performance pressure from Wall Street is not sentiment. It is the deliberate acquisition of human capital monopolies. The exceptional manager is an asset. The relationship that gives you access to that manager's decision-making in a crisis is worth more than almost any physical asset you could alternatively acquire. Charlie Munger expressed the underlying logic with characteristic precision. He observed that the limiting factor in any business, in any crisis, is almost never capital. Capital can be raised. The limiting factor is almost always the quality of the people making decisions. Before the crash, capital is abundant and competent people are merely well compensated. After the crash, capital is scarce and competent people are irreplaceable. The investor who has secured access to the irreplaceable people before the scarcity arrives has made the most leveraged purchase available in any market. London, 1815, the morning after Waterloo. Nathan Rothschild had better information than any other investor in London. His courier network had delivered news of Napoleon's defeat 18 hours before any other source in the city. He knew what the market did not yet know. What he bought was not gold, not victory bonds, not the obvious assets that every other investor would rush toward once the news arrived. He bought distressed debt, British government bonds that had fallen to catastrophic lows during the uncertainty of the Napoleonic Wars. Bonds that most investors had sold in panic, convinced that Napoleon's victory would make them worthless. When the news of Waterloo finally reached the broader market, those bonds recovered dramatically. Rothschild's position acquired at distressed prices reflecting maximum fear, appreciated to reflect the new reality of British military dominance. The pattern Rothschild exploited in 1815 is structurally identical to what distressed debt investors do in every major economic crash. When a company or a government faces financial distress, its debt trades at prices that reflect the market's fear of total loss. Those prices are almost always wrong, not because the debt will be fully repaid, but because the recovery value in restructuring almost always exceeds what panicked sellers are willing to accept. The distressed debt buyer is purchasing other people's fear at a discount to the mathematical reality of what the underlying assets will eventually yield. In 2009, the bonds of major American banks traded at levels implying the market expected catastrophic loss. Investors who bought those bonds at the depths of the crisis when the headlines were most frightening, when the consensus view was that the financial system was facing total collapse, generated returns that had been unavailable at any previous point in the post-war period. This is the fourth asset wealthy people acquire before and during crashes, not because they are contrarian for its own sake, because they understand that distressed prices reflect emotion, not mathematics, and the gap between the emotional price and the mathematical recovery value is the asset. The obstacle to acquiring. It is entirely psychological. It requires buying at the moment when buying feels most irrational, when every headline confirms that the world is ending, when the consensus view is that recovery is impossible. The wealthy investors who acquire this asset are not braver than other people. They have simply done the mathematical work in advance, calculated what the distressed assets are actually worth in various recovery scenarios, so that when the panic arrives and the prices fall to distressed levels, they have a number in their heads that makes the purchase feel rational rather than heroic. The preparation is the asset. The purchase during the crisis is simply executing a plan made when thinking was clear. This is the one that nobody talks about. not because it is secret, because it is uncomfortable. San Francisco, 2008, October. The financial system was seizing. Banks were failing. The word depression was appearing in mainstream newspapers for the first time in 70 years. Congress was debating a $700 billion bailout whose details nobody fully understood and whose passage was not guaranteed. In this environment, a small number of very wealthy people were doing something that looked, from the outside, like public service. They were appearing on television, giving interviews, writing op-eds, speaking to congressional committees, explaining in calm and authoritative tones what had happened, why it had happened, and most importantly, what needed to happen next. The narrative they constructed was not false, but it was selective. It emphasized certain facts and omitted others. It framed certain outcomes as inevitable and others as impossible. It defined the problem in ways that made certain solutions appear necessary and others appear reckless. The solutions that appeared necessary, when implemented, transferred enormous wealth to the institutions and investors who had constructed the narrative. This is narrative control, and it is the fifth asset that wealthy people acquire before every major economic crash, not by purchasing it in any conventional sense, but by building, over years and decades, the relationships, platforms, credibility, and institutional positions that allow them to shape how a crisis is understood when it arrives. The person who defines the crisis controls the solution. The person who controls the solution determines who benefits from the recovery. This is not conspiracy, it is structure. The structure of who has credibility, who has access to decision makers, who has platforms that reach millions of people simultaneously. These structural advantages are built over years of deliberate investment in relationships, in institutions, in the accumulation of the specific kind of credibility that makes people listen when the crisis arrives. Walter Bagehot, the 19th century economist who essentially designed the modern central banking system, understood this with unusual clarity. He argued that financial crises are not primarily economic events, they are narrative events. They are moments when the story that people tell about money, about what it is worth, about who can be trusted, about what the future holds breaks down and needs to be reconstructed. The person who reconstructs the narrative reconstructs reality. Because in a financial system built on confidence, the narrative about what is happening is not separate from what is happening. It is constitutive of it. J.P. Morgan, the man, not the institution, demonstrated this principle with extraordinary clarity during the Panic of 1907. When the American banking system was on the verge of total collapse, Morgan convened the key. Players in his private library locked the door and didn't let anyone leave until they had agreed to a coordinated response that stabilized the system. He was not acting as a government official. He had no formal authority over any of the men in that room. What he had was narrative authority, the credibility, the relationships, and the structural position that made his framing of the situation the one that others accepted and acted upon. The Panic of 1907 ended because Morgan said it would end. And because he said it would end with sufficient authority, the actions that were necessary for it to end became possible to coordinate. The wealthy people who acquire narrative control as an asset before crashes do not do so by purchasing media, companies, or bribing journalists. They do it by spending years building genuine expertise, genuine relationships with decision-makers, genuine platforms that attract genuine audiences. By the time the crisis arrives, the narrative asset is already in place. The crisis simply activates it. There is a thread connecting all five of these assets, and it runs directly counter to everything that conventional financial advice teaches about preparation for economic downturns. Conventional wisdom says, diversify, hold cash, buy gold, reduce debt, move to safety. These are not wrong. They are Simply the preparation of people who expect to survive a crash. They are defensive assets. The 5 assets we have examined are not defensive. They are offensive. They are the purchases of people who expect not merely to survive the crash, but to profit from it, to emerge from the destruction of wealth with a larger share of whatever wealth remains. The asymmetric information position profits from other people's incorrect consensus view. The legal architecture profits from the crash by protecting assets that would otherwise be claimed by creditors. The human capital monopoly profits from the scarcity of competence that every crash creates. Distressed debt profits from other people's panic selling below mathematical recovery value. Narrative control profits from the reconstruction of confidence that every recovery requires. Each asset is a position taken relative to other people's behavior during the crash, not a position taken against the crash itself. This distinction matters enormously, because it means the 5 assets are not available to everyone simultaneously. Their value derives precisely from the fact that most people are not acquiring them. The asymmetric position only works if the consensus holds the opposite view. The distressed debt only yields its premium if other investors are panic selling. The human capital monopoly only creates scarcity if most investors haven't secured the relationship. These are assets that function because of inequality of preparation. The more universally they are understood and acquired, the less valuable they become, which creates an uncomfortable conclusion that the historical record forces upon anyone who examines it carefully. The wealthy do not simply prepare better for crashes. They prepare in ways that are structurally dependent on most other people preparing badly. The asymmetric position is purchased from the person who sells at the consensus price. The distressed debt is acquired from the panic seller. The narrative is constructed for an audience that needs someone to tell them what is happening. The 5 assets are not simply preparations for survival. They are preparations for a specific relationship to the majority, a relationship in which the minority who hold these assets capture value from the majority who do not. This is not new. It is not a modern invention of financial capitalism. It is the permanent structure of how wealth transfers during economic crises have operated across every collapse in the historical record. Rome's wealthy families captured value from the denarius debasement through legal structures and information, advantages that ordinary Romans didn't possess. The Rothschilds captured value from Napoleonic uncertainty through information networks that no other investor could replicate. The Rockefellers and Kennedys captured value from the 1929 crash through asymmetric positions taken before the consensus recognized the crash was coming. The distressed debt investors captured value from 2008 through mathematical analysis done when others were operating on fear. The pattern is not the crash. The pattern is the preparation that precedes it. And here is what the historical record makes unavoidably clear. The preparation is not primarily financial, it is cognitive. It is the development of a framework for understanding what value actually is, as distinct from what the current consensus believes it is, that makes every other preparation possible. Without the framework, the 5 assets don't make sense. With it, they are the most logical purchases available in the months before a crash. The framework is available to anyone willing to study the history of how wealth transfers during crises. It has been documented in extraordinary detail across 2,000 years of economic collapses, panics, depressions, and recoveries. The wealthy people who acquire these 5 assets before crashes are not operating on secret knowledge. They are operating on historical knowledge that is publicly available, extensively documented, and almost universally ignored. History has been trying to teach this lesson since the first coin was debased by the first emperor who couldn't pay his bills. The only question it keeps asking is whether anyone is paying attention. Subscribe. This channel performs economic autopsies on history's greatest crashes. The pattern always repeats. The preparation is always the same. and the next. One is always closer than the consensus believes.